Hello, everyone, and welcome to another episode of the Reinsurance Podcast. I am your co-host, Jared Lee.
And I'm Ben Rose. Welcome to another episode brought to you by the Reinsurance Podcast. We don't have sponsors. This week, cool. All right, what are we talking about today, Jared?
Today, we've been sort of canvassing the market, and the question that everyone seems to be coming back to is what is sort of happening with the hard market? How long will this market condition be? Like, what are the things that are driving it? And we are the sort of very obvious people to answer such a question. So here we are to talk about how long will this hard market last, and what do we think will be the driving forces behind it changing, or capacity coming in, or evolving in a way that we no longer deem it to be a hard market.
So, I mean, maybe an interesting place to start before I unveil my many theories that I'm hiding under this imaginary cape would be to ask why this hard market started in the first place. You know, what was it that led us to suddenly go from a decade of soft market cycles to pivoting to a hard market now? And then maybe we can ask to what extent we expect those conditions to continue.
Before we dive into that,
a prequel to the prequel.
Yeah, exactly. Just you wait, it keeps going back. This is like a Timothy Chalamet prequel. Willy Wonka reference? Missed it. Yeah. No, but how would you define a hard market? I think it's kind of one of those things that seems to be people know it when they know it. But what would you qualify as like the characteristics of, these things have happened, therefore hard market? Like,
so before we do that...
it is a prequel to a prequel.
We have to tackle the market cycle then.
Yeah, fine.
But yeah, I'm going to do that.
Okay.
I'm going to answer your question. So at its simplest, we in the insurance and reinsurance industry have come up with a terminology to describe something that happens in basically every industry, which is there is a relationship between supply and demand that determines prices.
Have we coined such a theory?
And effectively, the hard market or the soft market in reinsurance refers... I find it easiest to remember it this way, so here's my tool. During a hard market, it is hard to buy, whether it's insurance or reinsurance, because there is a more limited supply of capital available versus the demand that would like to buy coverage.
Sure.
So it's hard to buy in a hard market for our listeners who maybe haven't come across this concept before, whereas... we don't call it the easy market, we call it the soft market, because they went for a different opposite. In the soft market, there is tons of capital available, at least relative to the amount of demand that's looking to buy. And the result, of course, being that there is more power or negotiating leverage effectively with people who have all of the demand and have lots of choice about who they buy from. Whereas in a scenario where there's a constrained amount of supply, the supply can be choosy about who it offers to insure or reinsure. Yeah. But that's the concept of hard and soft markets, and they do something called cycling.
Yeah, so then you'll see as the market goes through its various phases, which we've deemed cycles, as prices harden and it's more expensive for insurance companies to purchase reinsurance and the terms are better for the reinsurers, you've historically seen an influx of capital coming in, and that sort of increase in supply, I guess we would sort of deem it. Like, supply and demand gets weird in our space because you have buyers assuming risk and things. But an increase in the supply of capital then sort of starts to bring the prices down. And at a certain point, you get to sort of where there's a surplus in capital that's not being deployed and it begins to leave, or in what we've seen in this more recent one, an increase in the number of claims or losses and the lack of profitability has caused the reinsurers to exit in some places, sort of drying up the supply, which, as you've pointed out, results in the cedent sort of going, ooh, it's more difficult to buy. This must be a difficult market. But it results in the cedent having a harder time securing the capacity at the price that they term. And you see the very similar sort of supply and demand chart where the price for that policy or the price for that coverage will be sliding up and down based on the available capacity in some ways.
And it's to add another sort of dimension to this, it's far more complicated than, the number of cedents outweighs the number of reinsurers or something like that. You do have a healthy price elasticity of demand built in here as well, in the sense that if reinsurance is expensive, cedents can choose not to buy it. Or if it's cheap, they can choose to buy loads of it.
Yep.
And we often do see people, using budgets in quite a consistent way. So, if this is their reinsurance budget, they may spend all of it every year, even if that gets them more coverage than they planned on.
Yeah.
Or if reinsurance is too expensive, they might live with, a bit less coverage than they would usually buy. Or it might be a budget determined based on how much business they've written themselves, which can be influenced by underlying rates, inflation, etc. So a ton of factors. I haven't even come on to alternatives, which we should in this episode at some point.
The other thing I wanted to sort of highlight, which in that sort of complex sort of map you've just laid out, is it's oftentimes is lazy to deem the entire market hard or soft. In many ways, it could be by geography, or sometimes even in the current market by class, where some classes have been performing quite badly, where reinsurers haven't exited the market as such, but they're no longer doing that much in that class or that much in that sort of peril territory, if you will. So certain parts of the market are much harder than maybe others. You might see marine sort of being relatively normal, or some parts of casualty being relatively stable, whilst you see some parts of the property market hardening quite a lot. So you see the bigger types of products, big property cat stuff being quite a market mover oftentimes, or the big casualty programs. But there's more complexity to that. So it doesn't mean every program an insurer buys is more expensive or harder to buy. We sort of have to think about it with that level of nuance and sort of a lens on that, as well as we sort of think about market conditions more broadly.
Absolutely. And I think, there's tons to unpack here, isn't it? Good thing we've got a whole episode on
Buckle up, listener.
We're going to run out of time. We haven't even got back to the original, my original proposed starting point yet. And we won't, because I still want to cover as well. We think about hard and soft markets being a state, but I guess in some ways they're directional, right? It's not like suddenly reinsurance or insurance is expensive or cheap. It's more that prices are increasing or prices are decreasing. It's the direction of those prices. So although, for example, at the moment we consider ourselves to be in a hard market, that doesn't mean that prices are higher than they were 3 years ago when we were very much in a soft market, or even 7 years ago when we were in a soft market. It's going to take a fair duration of the hard market potentially, or a certain angle of acceleration of the hard market in order for us to get back to where prices were during a very, very long soft market. And one of the biggest debates in this conversation, when is this hard market going to end, if at all, is partly based on where the middle is, where people believe the true price should be, and how capital, etc., will continue to respond to that.
So if we think about it then in this sort of market cycles piece, and focus your mental eye on a nice sort of sine graph, listener, where you have that. I think that directional piece is important, right? So soft is when the arrow is trending down, and then you hit a bottom and the arrow begins to trend up. And the entire journey up would be considered a hard market in many ways. If we are unclear, so we're looking either at where the top is, where it begins to sort of change direction and head back towards prices are decreasing, or you're seeing some sort of like asymptotic line where it's begun to plateau and it's like, oh, we've found sort of a stability equilibrium zone. And then maybe the question becomes, how long do we stay there before outside factors shift either supply or demand, and you see a directional shift again?
Yeah, absolutely. And I think also we could add a layer of complexity around whether it's real rates versus taking account of inflation, etc. Prices
or risk adjusted.
There's a lot of other factors to take into account. But let's jump to the question initially asked.
When will this hard market end?
No. The initial question for the episode. So what made this hard market come along in the first place? And are the conditions that led to it now answered, fulfilled? Or are we still answering the original questions that caused a turn?
So I think
an inflection point in the previous market.
So we talked about this in some episodes previously. And I think a couple of the bigger ones being the broader rate environment, interest rate environment, and I think you see this shift in losses. The losses piece. Let's start there. you've had an increase in catastrophes in both frequency and severity, and as we've sort of are heading into what's now been reported as going to be the hottest year on weather, even we know that in advance now, which is concerning to some people, what the impact that might have. But we don't yet know. I don't feel we yet have a lens as to what the new like loss equilibrium is. What you saw something was like the number of billion pound dollar plus losses in a year.
This has been the 6th year in a row that insured disaster losses have been above 100 billion.
Yeah.
Which used to be considered an exceptional
rare.
year.
Yeah.
And again, 100 billion is a number that's not been adjusted, etc. But that still, changes the way that we think about scale here.
So the reinsurers have to enter into a universe in a world where like that is what's expected.
But I guess equally, we're looking at a Lloyd's market specifically, to take another example, that's looking at a stamp capacity of like 50 something billion of premium, when I think back 10 years ago and it was on 25. So the amount of premium potentially that's sloshing around has grown quite a bit as well. The world is riskier. Yes, people are spending more on insurance there as well, which I think was a worry for a long time, that as a share of GDP, as a share of the world at risk, insurance was becoming a bit less relevant, arguably, which also may have made things challenging if we were just left with the bad risks.
Yeah.
But you could argue we're trying to track
Yep.
How much riskier the world is coming.
Yeah. So I think piece one will be the market coming to an understanding and to a level of comfort with the loss environment that they expect to be in, and calibrating their internal positions on that, but also maybe improving their ability to model those losses and adjust their prices, and in some cases for a reinsurer, build a portfolio strategy that accounts for certain classes having many large losses, but others being a bit more cyclical or similar. So I think that's the first piece, is getting comfort there. The second piece maybe being the supply, the interest rate environment driving or having an impact on how much supply is coming into the space.
Yeah, I think we had a number of events that we should come back to in a minute, but we had one big hurricane that kicked off sort of much more urgent conversations about rate change this time last year, well, just over a year ago. This year we haven't had that. We haven't had a single big hurricane event that's caused substantial losses. Yep. So perhaps this gives a chance of a more asymptotal sort of flattening of the curve for now. But as you said a moment ago, we're going into a El Nino year expected to be the hottest on record, possibly a 1.5 degree change versus pre-industrial levels climate-wise. Who knows what that's going to lead to when we come into next year. So it could be that even if we do have a relaxation from the hard market in its original level of acceleration, it might be that it picks up again quite quickly after that. So it was event driven to some extent. But I think I do have an interesting story for you.
Let's go.
It's not a story, an interesting theory.
Okay.
Which is that the hard market has in large part been sustainable into this year because of the number of topics available to underwriters upon which they've been able to point to uncertainty in the world around them. Sure. And uncertainty in terms of not necessarily directly risk-relevant factors, but factors that affect the overall supply of capital and its vulnerability. So if you remember what actually kind of led to real struggles with the previous hard market, it was retro capacity had suddenly gone missing, so nobody knew whether there was going to be reinsurance to buy until that became a bit clearer. So even if you think, well, actually it's not been a bad year for marine or whatever, or some individual class of business or some individual region, if the global pool of retro or reinsurance capacity becomes constrained or is hit by a major event, then you're going to expect prices to go up. And we have had hovering over that pool of supply it feels like a record number of simultaneous, what I'm attempting to coin, grey swan events, just waiting to happen. They're not black swan events that nobody thought would happen, but rather they're events that everybody knows could materialize, everybody hopes that they won't, but that seem impressively likely, especially in an era that's just been through the pandemic altogether, where something unthinkable that, yes, we had thought about had actually happened and had really changed the world for us. So I would point to, for example, the risk of another pandemic coming along. I would point to inflation, which, although has gone largely away to some extent, we may be on the brink of another resurge in inflation. Who knows? Especially if you look at the Middle East right now. You may see a continuation of the Ukraine situation that shows no current sign of abating. It's just sort of overhanging or an escalation. You have the Middle East situation, you have climate change that we've already discussed, and then you have going into 2024, I think it's actually the first time in history that more than half the world's population will be voting in elections. So we're going to have
a lot of uncertainty,
massive upheaval politically. In particular, everyone's looking to the US to see what happens there, because potentially policy changes there could make a whole host of events more or less likely. I think lots of analysts have also pointed to a window of risk around a China-Taiwan situation as well.
So
within next year, and none of these are expected to happen. Like, you look at the numbers, even a Trump presidency coming back is, I think, 30% is like one of the numbers that's been put out. But it's all everyone can think about. It's the same for climate change. Like all of these issues, statistically, doesn't feel like they're necessarily going to happen, but they're all just hovering in the minds of everybody who's sat on risk capital.
Because what you sort of have is, as an industry, we've sort of categorized it into two buckets previously. You either have a very large black swan events that are rare, but they're huge when they happen and they shift the market. But you can kind of go, these are our 1 in 100, 1 in 500 year events, and that's what those are. Or you have B, lots of little aggregation. But you're sort of introducing a third category, which is they're not quite as big as the mega cats, but there's a lot more of them, and they're way, way bigger than your traditional sort of aggregate sort of category. And so it's instead of there being 3 of these, there's 50 or 100 of these sizable things, none of which are sort of 10 billion plus maybe events, but are all independently so large that if half of these come off, it's going to really shake the market. And I think you're right there. That uncertainty is potentially keeping capacity out, do you think? Is that kind of the risk that you're seeing in the market from that?
Yeah, I think so. Not just keeping capacity out, but also just making it very hard to be a reinsurance broker to push for softer prices. Like, if you're a client or a broker and you want to go out to market and say, the world isn't as risky, you should be giving us a better price. There's so many things that an underwriter can point to, so many objections that you can raise. And to the exact same point, the LPs, or any kind of source of capital that might consider backing an underwriting operation at the moment, not only have they got the likely peaked but probably sustained interest rates as an alternative source of return on investment that they can use instead of the reinsurance industry. Not only that, but hovering over their minds is also, do I want to get exposed in an industry that has, direct interaction with these grey swan risks that could potentially, really, really ruin my investment. Whereas you don't have that if you're, choosing a much safer, seemingly uncorrelated investment, potentially.
Yeah.
But
So if we then circle back to...
That's why I'm dressed as a grey swan.
Yeah, exactly. If we then come back to the question at the very top of the show of when do we think this market will end, by which we're saying it will either flatline in its sort of continued rate increase on the whole, or begin to start to come down a little bit, what do you think is the answer to that then?
So the point at which we see the directional change, in part depends on how quickly it accelerates to that point. Everyone's happy as well, right?
Sure.
I feel we upset each other quite a lot during the previous year's renewals
Yep.
because it was such a sharp acceleration.
Yep.
And it left people without cover that they wanted. It left people...
Yeah.
People hadn't budgeted for a sudden shift in their reinsurance costs. Nobody was ready for those conversations, for like a radical...
Yeah, and they were using it like it was like a Band-Aid pull. Like it's gonna hurt year one. But it was an aggressive and fast reset.
And if you compare that to soft market cycle that we had for a very long time, it was more of like a gradual erosion of prices.
Yep.
I think this year's renewals will maybe give quite a strong signal.
Yeah.
In terms of direction, in terms of what people have paid as an increase this year, of how comfortable people start to feel about leveling that off a bit.
Yeah.
How quickly we accelerate there versus if I'm a pragmatic underwriter here and I think that this hard market cycle is caused by sustained factors that will continue next year and perhaps for several years afterwards, which to be honest with you, I think is quite likely. I would maybe consider being more patient and building in, a hypothesis of I'm going to be able to keep on increasing this account's rates gradually over the next several years, rather than being like, this is the last chance to benefit from the hard market. We've got to go all in now.
Yeah.
I don't see new capital coming to the market and stealing your share.
Yeah.
Anytime particularly soon. I would be pretty bullish on, let's keep customer relationships good. Let's give them a managed change that moves in step with, what feels reasonable and sustainable for us both. But, having an open conversation with the great relationships we have in this industry that really we're nowhere near where we need to be. We need to get there by 2025, 2026, and we'll collaborate.
I also think what you'll see is, so I agree entirely with the speed of execution around the hardening to get to that flat line sooner. I also think what you'll see is a little bit more collaboration from the cedent around like going, we got a bit greedy, perhaps maybe not use that term directly, but we got a little bit greedy with what we could get in the market before. But now as we establish like this new sort of, okay, we should have these risks on our balance sheet. We should be buying a bit higher because that's showing our sort of commitment to quality underwriting. And I think you'll see some of those conversations happen more. So we'll get to a point where the cedents have shifted what they think they should concede and the position that they want to start at, and then use that as a position of the starting the conversation with the reinsurers around, if we agree to sort of stay here, are you agree like in having that more of a collaborative alignment rather than over the sort of several years of the soft market, that slow erosion, as you said, where they sort of took a bit more each year, and then the very abrupt shift the reinsurers applied when the market hardened, to then reset on like, okay, we know we're doing this, we're in this together kind of conversation. Yeah. So I think that will help align it. But I'm super interested to sort of watch what 2024 looks like and see it. I think you're seeing the aggressive shift it doesn't seem to be there for the 2020 or 1/1/24 renewal. But as we go into the duration of 2024 and the year ahead, I think you'll get a sense as to what that looks like from a capacity perspective as well as from a sort of alignment perspective.
I think this should be a massive boom for our industry at the insurance level and the reinsurance level in terms of just scale, right? Like, yes, the losses are getting bigger, but right now you've got, AI risks arriving that weren't there before that are suddenly going to be huge. You've got an energy transition that's worth billions all over the world as people race to get access to rare minerals. You've got defense budgets being established, that range into the hundreds of billions. Yeah. There's so much demand right now for insurance that's going to flow through to reinsurance if we can position ourselves to take advantage of that and to be available to help people who need coverage in really, really uncertain times. Yeah. And the sort of converse of the fact that uncertain times are scary is that's when insurance becomes the most valuable. Yeah. So it's our chance as an industry to step in and make a difference and actually grow our value to the world. Yeah. So that was the longest no answer you're ever going to get on the podcast around what we think, but it's tough. It's complicated. So those are some of the things that we factor in, but there's no direct answer to something like this, which is why it's such an interesting area for us to dive into. But thank you for enjoying that one with us. That was an interesting discussion. Thank you. Yeah, we're going to flee the studio now because it's appropriate for this time of year. Absolutely freezing. It's like shaking in the studio. Until then, everyone, thank you so much.